Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Friday, everyone. These are the top stories that set your agenda. Risk relief. Stocks in Asia rebound with the region's benchmark on course for a sixth week of gains, while US Treasuries stabilise after this week's tax cut tantrum. We're going to speak with the US Treasury Secretary later this afternoon. Clearing the House. President Trump's multi-trillion-dollar tax bill overcomes opposition among US representatives. The Senate weighs in next. Plus, the White House orders Harvard to stop international enrollments amid sweeping allegations about the university, setting the stage for a court showdown. Let's get to the market action then. European stocks ended the day down 0.6% yesterday. The Asian session, though, has been positive, and you're getting that lift right now in terms of the futures picture for European stocks. Modestly higher by about 0.1%. It does seem like this is an equity market that is looking for direction. Worth noting, of course, the S&P 500 is still closing in on that bull market territory. But to what extent and at what point do the ruptures within the Treasury market start to pull down stocks? You have that stabilisation in Treasuries in the session today. We'll unpack that for you shortly. FTSE 100 futures pointing to gains of 0.3%. Consumer sentiment turning around here in the UK on lower interest rates. Again, that is a story that will continue to evolve. The GDP data as well. Some of that data out of the UK coming in a little bit more resilient than some had expected. S&P futures currently flat after a session that saw modest gains yesterday for the S&P 500. Nasdaq 100 futures down just 0.1%. Let's flip the board then and have a look cross asset. We want to focus in on what's happening, of course, in the Treasury market, given that yields did come in. They fell yesterday across the curve. The 30-year is still above 5%. We're going to get to Valerie Teitel shortly in terms of how to think about the moves in the Treasury market and tying that, of course, to the deficit concerns stateside. The benchmark 10-year at 4.52. Euro-dollar at 1.13. Gaining again on softer dollar. This softer dollar story just continues, doesn't it? And we'll see to what extent a floor can be put underneath that. Euro-dollar at 1.13, gaining 0.3%. Brent softer again on oil market reports. OPEC Plus is looking to add more oil to the market. That's Bloomberg reporting $64 a barrel on Brent, down 0.6. Gold at 3,315. The yellow metal getting another lift in the session, up 0.6%. Check the Asian markets then. It's been a decent session, as we said, on track right now for a sixth straight week of gains. The trade story and the easing of tensions there is certainly a factor. Up 0.5% across the regional benchmark. Inflation data out of Japan, interesting, coming in higher than expected. So expectations around the BOJ's next steps, of course, around 3.5%. Food prices, rice prices in Japan, really consequential right now. The Nikkei currently up 0.5%. The Japanese yen at 143, and the Hang Seng over in Hong Kong gaining 0.6%. Let's get to the Treasury story, though, right now, because Treasuries and the dollar are steadying after a sell-off triggered by worries over the surging US debt load. How long will that last, though? Let's bring in Bloomberg's Valerie Teitel for the breakdown. Is the freak out then in the Treasury market behind us, Val? We can take a big step, a big breather. It's done, it's dusted. We're all fine.
Tom, maybe that's the bullish case here, but I think it really does have an argument. We've stabilized in the 30-year yield, and if you look on the week, we're less than 10 basis points higher in that 30-year yield in the U.S. We started the week at 4.95. We're now at 5.04. Less than 10 basis points rise. In some way, you can argue the bond market has absorbed this fiscal stimulus quite well, and maybe we move on to thinking about the fact that the U.S. government has just passed another fiscal stimulus bill that will add some juice to the U.S. economy without a bond market freakout. I think this is maybe another important takeaway from this is that the bond market has absorbed this quite well. And you look at how U.S. economists, if they are looking at their 2025 GDP forecast, will this give them a reason to upgrade their forecast for 2025 now that we have, the fiscal floodgates open, not just in the U.S., but really across the world, Germany, in China, across the world, fiscal floodgates are open. And I think that really is kind of a bull case for the equity market here, Tom.
J.D. Vance, the U.S. Vice President, telling the New York Times recently that is what is expected. That's what we should brace for, is a reduction in those trade tensions, constructive outcomes on tariffs, and a tax bill that stimulates this U.S. economy. and you get the receipts that come through in terms of revenues, and that helps address the deficit concerns. That is the constructive outlook. That is the view, at least being positioned by the Trump administration. There are global implications to all of this. Where is your focus when it comes to that global ripple effect?
Yes, the global ripple effect has really been this week, at least on steeper curves globally. We saw the U.S. 530s curve breach 100 basis points yesterday, and it's really put pressure on a lot of other global markets, the United Kingdom, Germany, and even over in Asia, Japan. So this is going to be a theme. I think we might have to wait and see how the market digests this. Japan is really having some really impressive market moves in their long end. Those long end yields continue to rise. Now, whether that in some way forces Treasury yields to rise as well, who's exactly going to be leading the next move in the long end? I think that's a really great question to watch. My eye will be on Japan, because possibly some more steepening coming out of the long end of Japan could maybe force those long end yields higher in the U.S. But, Tom, I just want to repeat again, those 30-year yields less than 10 basis points higher on the week, and we did not breach those cycle highs that were around 518 in that 30-year yield. And I think that really just underscores the bull case for the equity market here. We could have, a U.S. economy having this fiscal stimulus without a bond market freakout, and I think that could lead global equities higher in the coming quarters.
Yeah, and that's despite, of course, the weak auction on the 20-year and the downgrade last Friday, of course, from Moody's. And then the market appears to have worked through that with the 10-year at 352. Valerie Teitel, thank you very much indeed. Now, President Trump's signature tax bill, which, of course, ties into all of this, is heading now to the U.S. Senate after a narrow win in the House. Some Republicans are still pressing for extensive changes as the White House urges its quick passing.
The One Big Beautiful Bill is the final missing piece toward ushering the golden age of America. The Senate should pass this as quickly as possible and send it to President Trump's desk for a final signature.
Bloomberg's Charlie Wells joins me around the desk right now to break down what we've been seeing. What is the next step, then? It's passed the House. It was a tortuous affair, but they got it there. What next?
Tom, the next step is uncertainty, because we know that when bills tend to move from the House to the Senate, there is a lot of deliberation that happens in the Senate. Senators do not like to feel like the House is telling them what to do. So that's one element here. Another element here is we are already hearing from a lot of these senators that they have questions about what's happening in the bill. You're hearing a lot of loud noise and a lot of fighting words from some of these deficit hawks, from the Rand Pauls, for instance, who really do not like what they're seeing on the way that this would contribute to that deficit. But you've also heard from some sounds from more moderate Republicans about these Medicaid cuts. They do not like what that would do to their constituents. And I think there's one part to this bill that was so controversial, and it was the SALT cap increase from $10,000 to $40,000. Now, what's striking about the Senate, what's different from the House, is that you don't really have this SALT caucus, because...
I mean, for an audience outside of the SALT, that's just like... So this is a specific state tax.
Yes, exactly. So this
carve-out.
is exactly. So a lot of these Republicans from in the House, from kind of more blue areas, they were really unhappy about a limit that their constituents could take on taxes, on state and local taxes, vis-a-vis federal taxes. But in the Senate, you don't necessarily have so much of this, because Republican senators tend to come from red states. So this is all to say that if and when this bill goes back to the House, it could be unpalatable for lawmakers in the House. So this is really difficult. There's a lot of uncertainty ahead. As you can hear, the White House wants this to pass really quickly. The Republicans really want that July 4th deadline. That is looking very unlikely. But we also know that Republicans in either House and in the White House, they do not want this to fail, because that would mean that tax hikes come into place on December 31st.
OK. It could still get salty in the Senate.
Very much so.
The Fed, is there a reprieve for Jay Powell? The Supreme Court weighing in and seemingly putting some guardrails around the chair of the Fed.
We got a lot more certainty on the job security of Jerome Powell. Now, Trump has talked in recent months about maybe wanting to fire him, maybe not. There being a lot of concern in the market on what that would mean. But basically, this is the Supreme Court saying that the Fed is a uniquely structured, quasi-private entity, and that the head of this independent federal agency cannot be removed unilaterally. Now, interestingly, they said that the president does have the authority to remove the heads of other federal agencies. They say that that's within his competency, but Elena Kagan, dissenting here, said that, this is a really, bad interpretation of Humphrey's executor, which basically set up independent agencies and, gave them power to remain independent from the president, kind of deciding to fire the heads of these agencies. So it looks like a Fed carve-out while a lot of this other dispute gets worked through the courts.
Yeah, that's interesting context, isn't it, as this administration tried to push the authority in terms of presidential power. Charlie Wells, thank you very much indeed. Jay Powell, it seems a little safer this morning in terms of his job on the back of that ruling. Now, the Trump administration, meanwhile, has blocked Harvard University from enrolling international students in a major escalation of its fight with elite American colleges. Harvard President Emeritus Larry Summers blasted the move.
This is vicious. It is illegal. It is unwise. And it is very damaging. Why does it make any sense at all to stop 6,000 enormously talented young people who want to come to the United States to study from having that opportunity?
Bloomberg's Jill Desis joins us now for the latest. Remarkable news. And, of course, what this signals about universities, top elite universities in the US and their attractiveness for foreign and international students and the ripple effects of this potential decision. Jill, what do we know right now about this ban? Is it in force? What is the pushback? Where does this go from here?
Yes, well, obviously, this is a very rapidly evolving story right now, Tom. But essentially what's happened is the Department of Homeland Security, led by Kristi Noem, has revoked, they're revoking the ability of Harvard to basically have international students. And so what that effectively means for those students is that if you're already enrolled at Harvard, or if you were going to matriculate in the fall for, say, in the upcoming term, you need to transfer, find another university to go to, or else you lose your student visa status in the United States. So that's essentially what is happening here. This, of course, stems back to some efforts by the Department of Homeland Security under the Trump administration to get Harvard to supply records of what they were saying is potentially violent or illegal activity by any of its students, whatever that record may be. Of course, all of this stemming back to sort of a long-standing issue the Trump administration, in particular, has taken with big elite universities in the United States and some concerns about protests, anti-Semitic activity on campus. So that's really where this comes from. Of course, how enforceable this is, whether Harvard actually goes and then challenges this in courts, as they've done with other, other issues that the Trump administration has brought to them, or for example, their efforts to pull federal funding from Harvard. We'll have to see how that actually ends up in the courts, but that's at least what the directive from the Department of Homeland Security is saying right now.
Jill, how is the university, how is Harvard responding at this point?
So at this point, they've released a statement. They've said that, this action is unlawful by the Trump administration. They're saying it. They are fully committed to maintaining Harvard's ability to host international students and scholars who hail from more than 140 countries. They're working quickly to provide guidance and support to their community. I'm reading you the statement that's Harvard's released right now. Now, again, in terms of what this actually means for Harvard going forward, we've spoken to legal experts who've said that, there's a possibility that they could attempt to try to get a stay of this kind of decision, given that it directly affects the abilities of students to enroll or remain enrolled at the university. So that's potentially one option, is that they get some kind of a temporary reprieve as this works through the courts. But again, all of this kind of, in concert with a lot of the other actions that the Trump administration has taken, that includes freezing more than $2.6 billion worth of federal funding for the university, really does kind of show you, how big of a battle this has really become between the Trump administration and Harvard.
What is also it signaling, Jill, about the Trump administration's domestic agenda and the picture it paints for us?
Well, really, Tom, I think, this really goes back to that broader issue that Trump has really, put in his sights, has taken, set as a target a lot of these big private elite universities in the United States. So not just Harvard, but other universities like Columbia, for example, in New York. Again, all stemming back to a lot of, protests on campus that have particularly taken place in the aftermath of the initial Israel-Hamas conflict dating back to 2023. We saw a lot of protests activity happening on some of these campuses. Trump administration saying that these universities have not done enough to combat anti-Semitic actions in particular. And so that's really what they're citing for, this Harvard case. But also, again, that's really come up in, some of these other cases involving universities. We know that, again, the Trump administration has taken, action to freeze federal funding. But where this latest issue comes up, it really is an enormous escalation just because Harvard has about a 27% of its student body, so more than a quarter of its student body comes from overseas. So you're looking at a pretty big freeze in tuition there if those students are not allowed to matriculate and study at the university, pay tuition there. I mean, the university does have the U.S.'s biggest endowment. It's about $53 billion, but a lot of that is earmarked for specific financial aid or other programs, and so can't be used, sort of for looser revenue. So again, if this is the kind of thing that's held up, it really does indicate that this is a pretty serious escalation here in what the Trump administration isn't how it's interacting with these universities.
OK, Bloomberg's Jill Desus, thank you very much indeed. The latest, of course, step up in terms of that battle between the Trump administration and Harvard. Pretty major escalation there. Coming up, bringing American AI to the world. We're going to look at OpenAI's latest plans to boost global data center capacity. Details on that story next. This is Bloomberg.
Earnings season is here.
European earnings season in full swing.
They're coming left, right, and center.
It is the earnings season that is dictating the narrative.
Bloomberg is first to break the numbers.
The banking sector, that's the auto sector, HSBC, BBVA, BNP Paribas,
Continental, Ferrari.
All of them really delivering.
With the smartest insights.
I think the rebound that we have seen has been surprising.
The results hit another record high.
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Bloomberg has learned that OpenAI is looking at the Asia-Pacific region for future data center sites, joining a heated race, of course, to build out AI infrastructure. It follows the ChatGPT maker securing a deal on a massive data center project in Abu Dhabi.
I do think what is going on here is that the world understands that we are in a moment, that there is an imperative to getting access to this technology. The U.S. does have the innovation lead right now, and can the U.S. leverage this lead to bring our version of AI, a democratic version, to the rest of the world, and as part of that process, bring investments back to the U.S. as well?
Let's bring in our Asia tech reporter, Annabelle Drulers. And Annabelle, you're perfectly placed to talk about this, given the expansion plans then for OpenAI in Asia. They've kicked off, they've fired the starting gun in terms of Stargate beyond US borders with this huge data center plan in the Middle East. But Asia is also in focus. Talk to us about the expansion plans.
Yeah, well, it's definitely still in the planning stages, but there's a lot of countries possibly in this region that are vying to be the next site for some of these major data centers from OpenAI. So this is reporting according to our sources, but what we're understanding is that OpenAI's chief strategy officer, this is Jason Kwon, is going to be visiting this region in the coming week, or starting in the coming week. So some of the sites or countries he's looking to visit: Japan, South Korea, Australia, India and Singapore. That's again what we're hearing from our sources, that these could be the stops on the trip. But certainly it's a very, very heated race now to build out AI infrastructure in this part of the world. And actually APAC is home to more data centers than any other region in the world, because there's already capacity expansion plans from Alphabet, Microsoft, Meta as well. But as you said, very interesting timing, given we just had the announcement with OpenAI in the UAE and developing that massive data center project rather in Abu Dhabi.
Annabelle, what is our understanding of how much support OpenAI is getting from the US administration, from officials in Washington with this effort, or is there some friction?
there's bound to be some friction. I think if you take, for instance, again, going back to the Middle East deal, certainly when that was announced, there was some concerns that we were hearing from officials within the Trump administration that they were worried about the strategic implications of this, what they consider, what they see as sort of an offshoring of American AI capabilities. And there's also those sort of more national security concerns as well when you're offshoring that amount of advanced US semiconductors and to countries or regions as well that have still very deep connections with China. And so, yes, that certainly could be part of the blowback of this, but it's very much aligned with the strategy of OpenAI because they've already announced, for instance, earlier this month to partner with governments that they see as having those shared democratic values, those shared open markets. And as I said, there's no shortage of companies or countries, rather, that are vying to be the site for these data centers because what we're hearing is that more than 30 countries have reached out to OpenAI so far to discuss the effort to help develop AI infrastructure locally as well. So again, and OpenAI, just to note, is committed to doing local language and meeting local needs, and their plan is to focus on 10 partnerships across regions.
OK, Asia Tech reporter Annabelle Drulas on the ambitions of OpenAI in terms of the infrastructure story beyond US borders. Thank you. Staying with tech, Bloomberg has learned that Apple is looking to release smart glasses at the end of next year in a challenge to rival Meta's Ray-Bans. Sources say the glasses would have cameras, microphones and speakers and handle tasks such as phone calls, music playback and live translations. Meanwhile, Apple has shut down work on a camera-equipped Apple Watch, but is still looking at AirPods with cameras. Plenty more coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Friday, everyone. The chair of EQT has told us the impact of policies from Washington is making the Swedish firm more attractive to investors compared to rival private equity groups based in the US. Connie Johnson spoke exclusively to Bloomberg's Kriti Gupta.
It has been rather favorable for us not being based in the US and being a US firm. Because the ones we're competing with is almost exclusively the US firms right now. And they are having some headwinds out in the world for reasons caused by others than themselves. And the flip side of that is that people are looking more for managers that are not based in the US and maybe to deploy money with GPs that is not US based or US dollar denominated. So it has benefited us, especially in Asia, but I would say also in Europe to some extent.
What do you say to global investors that are looking to invest in Europe or saying, give me a reason, Connie, give me a reason that Europe will suddenly wake up and catch up to the rest of the world? Is there a reason to be optimistic here?
Well, Europe would never have been able to get organized without getting pressure from somewhere. And now we got pressure from the US, and now we are trying to get organized. So it's clearly so that the understanding of the necessity of change is there. Now we are waiting to see the actions. We see some signs, but there are so many things that needs to change to get Europe back to a position of competitiveness. And it's talked about, and everybody travels around, meets and discusses these kinds of things. But it has to be proven that we also can get into action and create the right regimes, regulations, allowance to consolidation. We need to have one common capital market. We need to have a handful of strong, big, successful European banks. Basically, we have maybe one today in Europe. And those things need to be put in place, and they need to be put in place by the politicians, unfortunately. And that's, of course, it's a bit scary, but we are hopeful that we'll get there. And we're helping them. We are participating in the dialogue around that.
OK, EQT Chairperson Connie Johnson there, speaking on some of the benefits that they are feeling as a result of concerns about investments in the US. Coming up, Treasuries steady after a rally sparked by concerns about the mounting debt load in the US. Tatjana Greil Castro, public markets co-head at Muzinich, joins me next with a focus on fixed income and credit. Stay with us. This is Bloomberg. morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom McKenzie in London, and these are the stories that set your agenda. Risk relief. Stocks in Asia rebound with the region's benchmark on course for a 6th week of gains, while US Treasuries stabilise after this week's tax cut tantrum. We're going to speak with the US Treasury Secretary later this afternoon. Clearing the House, President Trump's multi-trillion-dollar tax bill overcomes opposition amongst US representatives. The Senate weighs in next. Plus, the White House bars Harvard from international enrollments, leaving more than a quarter of the student body in limbo. Let's get to these markets then. Equity markets seemingly searching for direction. European stocks were lower by the end of the close yesterday by 0.6%. Today, on the front foot, modestly, pointing higher by 0.2%. FTSE 100 futures here in the UK looking to add 27 points. The consumer sentiment surveys suggest a bit of a moderating turnaround to the upside for the UK consumer on lower interest rates. S&P futures, meanwhile, after eking out gains of 0.1% yesterday, currently flatlining. Nasdaq 100 also largely unchanged as well. Let's have a look cross-asset. The focus on treasuries, the focus on the dollar set for losses potentially this week of around 1%, potentially a little more. Euro benefiting on the back of that, up 0.3% on further dollar weakness at 113. The benchmark US 10-year, meanwhile, yielding 4.53. Bit of stabilisation, as we mentioned, in the treasury markets, with yields coming lower yesterday. And in terms of the oil price, OPEC Plus expected to add additional barrels of oil, potentially. That is being debated as soon as July. That is putting further pressure on the oil market. $64 a barrel on Brent. And gold getting a lift up 0.8% for the yellow metal at $3,321 per troy ounce in the session. President Trump's tax bill then sending ripples through the bond markets this week. Let's bring in Bloomberg's Valerie Teitel now. Valerie, just bring us up to speed. There's been volatility in these treasury markets. At one point earlier this week, a pretty significant sell-off, the 30-year above 5%, and then some reprieve yesterday. Why?
Tom, I think the most important thing is, yes, we did get that rise in 30-year yields, but we've really stabilized to end the week. And you can claim that, look, the Treasury market in the long end, we're only 10 basis points higher on the week. The bond market has really quite absorbed the fact that the U.S. government continues to spend even with an already historically wide peacetime deficit. So there's definitely an argument out there to think, hey, the Treasury market really absorbed this quite decently. This is a 30-year yield on the week. We're at 5.05 at the moment, 10 basis points higher in the last 5 sessions. I just want to show a chart about the Treasury market size. Now, this is something that is going to be important, I think, going forward, is will this extra spending from Washington cause in some way the Treasury Secretary to have to increase auction sizes going forward? We're already nearing 30 trillion in terms of Treasury market size. It's really almost doubled since COVID. And that goes to kind of set up the framework for this pressure on long-end yields as we continue to focus on the excess supply and maybe not a lot of demand out there to absorb these extra treasuries. It has caused steepening across the curves globally. Take a look at the global framework. We've got UK long-end yields rising, Germany long-end yields rising, and Japanese long-end yields rising. I just want to point at the Japanese yields just one moment. This is this purple or this blue line here, the Japanese 30-year yield. It's really spiked in the last month, up around 60 basis points. It's leading me to wonder whether the next catalyst for a long-end yield move could actually come from the east.
OK, so look to Japan for action as we see yields pointing higher as well. In some levels, at least on the long end, at kind of near record highs. Valerie Teitel, thank you very much indeed. Let's stay on the bond markets then, and we'll dig into credit as well. But we'll start macro and bring in Tatjana Greil Castro, co-head of public markets at Muzinich. Tatjana, let's start with you on the breakdown in terms of what's happening in the bond markets. You saw that significant selling pressure of US Treasuries at the start of the week. Part of that seems to be triggered by Moody's. Then you have the anxiety about the tax and spend bill for the US. And now stability, at least in the last 24 hours or so. What do you read into the action that we've seen this week and what it tells us in terms of pricing across treasuries in the weeks ahead?
Good morning, Tom. So Valerie, I think they did an excellent job in laying things out. And it is there actually doesn't have to be selling pressure, right? I mean, there's just if there's a lack of buying, given that the Treasury market is expected to grow by about 50% again over the next 10 years. So and it has just grown by that much over the last 5 years. So there has to be continued demand, but I mean, there's so many things going on, and I'll try to pick out a few, and we'll probably won't be able to get through all of them. But this is clearly, now the narrative has changed with regards to exceptionalism. There is still a lot of overhang with regards to tariffs. I mean, there's some loose agreements have been made. Some of it has been postponed, for the 90 days. So we haven't really seen the outcome yet on the largest trading relationship, for instance, with the EU and the US and China has been sort of postponed, right? But things haven't been fully agreed. So that will come back on that. And then even so, the big, beautiful bill has now been passed in Congress. It has to go up to Senate, and then it's not expected to be passed in the form that it currently is. So things are still changing. Things are still in flux. When we look at, as Valerie has pointed out, the shape of the yield curves, when you look at the shape of the yield curves and what the US looks like at the moment, actually it hasn't underperformed, despite this lack of fiscal discipline that is much more embedded than it is in other fiscal regimes. And so actually, when you look at it compared to others, and when you just look at how the 30-year bond has behaved since the beginning of the year, it has underperformed the 30 Treasury. So you can see that just based on that, actually it looks painful. Everybody's looking at this 5% hurdle. But we can see there with the backdrop of still decent growth, slowdown in growth, but no recession, inflationary pressures. So when you look at the 333 from Bessent, you can see there to be closer to 3% inflation. We are not getting real growth of 3%. So, we're lagging behind there. And we're not coming down to the 3% deficit. So everything points to higher yields at a steeper curve.
High yields and a steeper curve. Do we get above 5% on the US 10-year? And what does that mean in terms of the read across to growth?
Well, that would be clearly painful for growth. And that is something where I think this is where really also the government would sit up and that could happen actually now over the summer months as the big beautiful bill is being discussed, right? Because this is not done, and so that could also influence potential changes. Yes, the 10-year at 5% and staying at 5% would have a negative impact on growth. It would have a negative impact on investments. Having said that, international firms, you can see that already, they are coming to Europe to fund. So we have a huge surge in reverse Yankees, meaning US companies funding themselves on the European debt market because it is significantly cheaper for them to do so. So for very large companies, there is other ways to look for funding. But for smaller companies who are more local, who don't have the international revenues to diversify, for them it would be harder, and it would clearly lead to a slowdown in growth, particularly for US companies.
Well, Tatjana, what do you like on that point? What do you like in credit at this point? What are you looking to add?
So what we like is, first of all, when we look at the earnings profile that we see at the moment, the earnings profile has been relatively strong. And even if there is a slowdown in earning growth, there's still expected earning growth. Generally, we like Europe over the US, and that is just because you don't even need to look at the fundamentals. The return profile looks much more attractive. One of the reasons is because the discrepancy between ECB rates and Fed fund rates, and that is leading to very high currency hedging costs. So it's difficult to buy dollar assets for non-dollar denominated investors. And you can see that now when you look to Asia, who used to buy dollar denominated assets not hedged, and that clearly worked well over the last many years because the dollar was pretty strong. But now that the dollar is weakening and is expected to continue to suffer some, there is not this demand for dollar-based assets and definitely not unhedged. And if you start hedging dollar assets, all this yield advantage is actually going away. So, and then clearly, as you know, has been discussed now broadly, is there is this demand for non-dollar assets and also non-US companies, and clearly Europe is benefiting for it. So we start with a higher carry. We also have a steeper curve in Europe, so that benefits in total return, because as you roll down that steep curve, you take the total return up front, and we get those more attractive spreads. So that's definitely something that we have been adding to. And then on top of that, we are also actually re-looking at emerging market. Now, from the outset, emerging market doesn't really offer much value at all because spreads look tight on a historical basis. But I think what we need to reconsider is those emerging markets, and particularly the ones where they have a corporate bond market, they have largely emerged. They have dynamic economies. Their fiscal situation is healthy. They have good growth rates. And so the companies that are issuing from those countries are actually in a pretty good position. And so when we look at it on that basis, I think we need to give it another look.
OK, Tatjana Greil Castro on the opportunities in European and EM credit. Keep an eye on some of the opportunities there and expectations that you'll continue to see yield curve steepening in the US. Tatjana Greil Castro, co-heads of public markets at Muzinich. Thank you. Now, some of the stories making news this Friday. UK consumer confidence rebounding slightly in May as the Bank of England eased borrowing costs and the government struck a trade deal with the US. GfK's sentiment gauge reached -20, up 3 points from April, when US President Trump's escalating trade war fueled anxiety about the economic outlook. The latest reading was higher than expected. The Trump administration has issued a report blaming the rise in chronic diseases in the US on unhealthy food ingredients, chemicals, and over-reliance on medication. The 69-page document was compiled by the Make America Healthy Again Commission, led by Health and Human Services Secretary Robert F. Kennedy Jr. While sweeping in its conclusions, it stopped short of attacking growers and manufacturers as much as they may have feared. UK pharma giant GSK has won US approval for its drug to treat a deadly lung disease, ramping up competition with rival Sanofi. The FDA approved Nucala as an add-on treatment for some patients with chronic obstructive pulmonary disease, a leading cause of death globally. Spain's government is pushing ahead with a controversial proposal to hit non-European Union residents with a 100% tax when buying homes, as it seeks to tackle a brewing housing crisis. Prime Minister Pedro Sanchez's Socialist Party presented the plan as part of a broader housing bill submitted to Parliament yesterday. Coming up, electric vehicles have turned a sleepy corner of China into the country's lithium capital, but few operators are actually making a profit. We're going to dive into today's big take. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some of the stories making news. A man charged with the murders of 2 Israeli embassy staff in Washington has appeared in federal court. 31-year-old Elias Rodriguez wasn't required to enter a plea and will face court again in June. Officials have called the shooting outside the Capitol Jewish Museum on Wednesday an anti-Semitic hate crime. It's been condemned by the Israeli government, President Trump, and US lawmakers from both major parties. Iran says it will retaliate and hold the US legally responsible if Israel acts on reported plans to attack the Islamic Republic's nuclear facilities. The warning was issued in a letter addressed to the Secretary General of the United Nations and the UN's nuclear watchdog. Iran's foreign minister urged them to take effective measures aimed or against Israeli threats. US Treasury Secretary Scott Bessent kept a low profile during this week's gathering of G7 finance chiefs, but sources tell us he made a noted impact privately, offering counterparts a sense they could work with him on key issues. On the sidelines of the same meeting, ECB President Christine Lagarde warned that international trade will be changed forever by the tensions over tariffs. And it's reported Donald Trump's trade negotiators are pushing the EU to make unilateral tariff reductions on US goods, saying without concessions, the bloc will not progress in talks to avoid additional 20% so-called reciprocal duties. That's according to the FT. The US trade representative is preparing to tell his EU counterpart today that a recent explanatory note shared by Brussels falls short of US expectations. The EV revolution has turned a once quiet part of central China into the country's lithium mining capital. But Bloomberg has found that few operators there around the city of Yichun are actually making a profit. It's the subject of today's Big Take, with broader implications, of course. Dan Murtagh joins us now from Beijing with the details. Dan, why is China so keen then to develop its domestic resources that, of course, are so central to the EV sector?
Yeah, for a long time, Tom, China's economy has been based on importing natural resources from other parts of the world and then using those resources to produce, manufactured commercial goods, consumer goods that it sells to the rest of the world. But in the past couple of years, with increased pressure from the U.S., it's starting to try to build a little bit more self-resiliency. And one of the places that you can see that really clearly is Yichun. It's this small, by China standards, small, it's several million people, town in Jiangxi province that's rich in a very low-grade ore for lithium. And, now we were there a couple of weeks ago, and it's just trucks are rumbling down mountains filled with this ore every 30 seconds or so. Processing plants are doing their best to turn it into battery-grade material. And to try to make sure that China is increasing its production of this stuff and becoming, less reliant on importers like Chile and Australia.
Yeah, so it's part of that self-reliance story. So there's a lot of activity, there's a lot of demand, but you and the team found that actually many of these companies are not actually making any money.
Yeah, a lot of these mines were started a couple of years ago when lithium prices were sky high, but they've fallen about 90% since 2021, and now this ore that Yichun is rich in, it's called lepidolite. It's very low grade. It contains 1-2% of its mass is actually lithium, and so it requires a lot of expensive processing, heating, chemicals, and then it requires a lot of dealing with environmental waste, which is also very costly. And so it's incredibly expensive to process. But these companies are still doing it, in part because there's, government pressure to keep jobs up, but in a large part also because there's these long-term strategic concerns about making sure these resources are ready if anything were to happen that would block them from foreign sources.
Dan, how is the local government balancing the need, and the pressure's there, isn't it, from the central government to ensure that there aren't too many, or that the environmental impact of heavy industry is not overly significant? We know that is a bigger issue now for the authorities in Beijing. So how are the local provincial authorities squaring the need for this sustainable supply chain with an environmental cost?
Yeah, there's undoubtedly there's going to be an environmental cost anytime there's resource extraction. But several years ago, when this boom first started happening, there were reports of people dumping waste into rivers, and high pollution levels in rivers that are used by locals to wash clothes, to water their gardens. This is a beautiful part of China with lush green mountains, brilliant yellow fields of rapeseed flowers, and the government really wants to protect it. So, what we saw were, new developments of tailing ponds with, thick vinyl coatings that wouldn't allow any water to leak into the local drink water supply. Those trucked roads coming down from the mountains, every 30 or 40 meters, there were little water sprayers to keep the ore moist so it wouldn't, fly off and get into the local rivers and streams. So the government's definitely putting some effort into making sure that the river and the environment stays clean. But again, those efforts require costs for companies, and it's costs that eat into already tight margins.
OK, Bloomberg's Dan Murtagh in Beijing. Thank you very much indeed on today's Bloomberg Big Take. Really fascinating in terms of the read across for the supply chain for China, within, of course, the electric vehicle battery space, the components that go into that. There's a lot more coming up. We're going to break down some of the data out of the UK and, of course, focus back on the Treasury story with those bond vigilantes kept at bay, at least for now. Stay with us. This is Bloomberg.
Consumers are starting to pull back on their spending, and business owners are starting to push off capital expenditures.
We just think there's going to be a business cycle, and when that happens, the Fed's going to have to cut rates.
You have a substantial amount of uncertainty in almost every market.
The tariffs are not going to be as bad as we thought on Liberation Day, but they're still not going to be zero. And I think as we get more data that comes out, markets aren't priced for disappointment.
I think some people are probably not so much selling America as maybe not adding as much to America as they got in the habit of doing.
And so you're getting back to, okay, this is a storm, but we'll get through the storm.
People used to be very U.S. exceptionalists, U.S. And we have seen some shift from U.S. to other countries since the beginning of the year.
I think we should all be very careful. There is too much debt in the system.
We have seen a de-escalation, but we still know that some tariffs need to be negotiated, that we're in a period of pause.
Some of our guests at the Qatar Economic Forum in Doha with their views on President Trump's trade war, and that ties us, of course, to what's been happening in the Treasury markets and the volatility and the ructions we've seen this week. Stabilisation, of course, today when it comes to the Treasury markets. But here is the pain point then for those bond investors in terms of the issuance from the US Treasury. Just in the last few years, you see that huge take-up, of course, and issuance during COVID. We know about that. It's what's happened in 2024 and 2025. $2.5 trillion this year alone. And the tax and spend bill, multiple $1 trillion tax and spend bill working its way through now to the Senate, of course, is likely to add to that. The Trump administration would say tariffs and the money coming in from that will offset, as will some of the growth that is expected on the back of this fiscal stimulus, if indeed it finally gets to the president's desk in terms of this bill. The deficit is running at about 6%, debt to GDP about 100%, projections it gets to 120, 130 within the next decade. That is a potential pain point then if you're looking for those bond vigilantes that seem to rear their head at least the beginning of this week, even as we see that stabilisation in the session today. Let's get a view on Bitcoin, because you're still above that 110,000 level, the last time I checked at least, in terms of Bitcoin pricing. You broke above 111,000 for the first time on record yesterday. The outperformance of Bitcoin versus the rest of the crypto space, how long does this continue? Interestingly, our MLive team putting a piece out this morning suggesting that the stable coin regulation working its way again through the process, the policy-making process in Washington, could be a piece of legislation that lifts a tide that lifts all boats when it comes to the crypto space, and that maybe there's an opportunity for the rest of the crypto space to catch up with the gains that Bitcoin has seen. UK retail sales dropping in the next couple of minutes. The team at Opening Trade will break that for you at a time when consumer sentiment seems to be a little bit less worse, less bad than it was in terms of the surveys that have come out recently. The expectation year on year going to get put in 4.4%. We'll see if retail and the UK consumer is turning around. Stay with us for the Opening Trade. This is Bloomberg.